How to calculate intrinsic value of a stock. Determining the intrinsic value of a stock is a vital skill for investors seeking to make informed decisions in the dynamic world of finance. It's a meticulous process that involves evaluating a company's worth beyond its market price. In this comprehensive guide, we will unravel the art of calculating the intrinsic value of a stock, equipping you with the tools to navigate the stock market with confidence. 1. Understanding intrinsic value. In the electrifying world of finance, intrinsic value emerges as the elusive treasure chest buried beneath the tempestuous waves of market frenzy. It is the holy grail that reveals a stock's true essence, stripped of the capricious dances of market whims. Understanding intrinsic value is akin to deciphering the secret code to unlock a stock's hidden potential. At its core, intrinsic value is the North Star, guiding investors to the heart of a company's worth. It transcends the vagaries of market prices, standing resolute as the steadfast benchmark. It beckons investors to embark on a journey of enlightenment, where numbers and analysis are their trusted compass. This enigmatic value is not uncovered through mere chance but rather through meticulous examination. It calls for a deep dive into the labyrinthine corridors of a company's financial health, an exploration of its very DNA. To discern intrinsic value, one must analyze financial statements like an archaeologist unearthing ancient relics. It necessitates a keen eye for patterns in earnings, an evaluation of the robustness of cash flows, and the uncanny ability to peer into the future, foreseeing growth prospects. Market conditions may be stormy, with waves of speculation crashing upon the shores of financial markets, but intrinsic value remains the lighthouse, casting its unwavering beam. It is the fulcrum upon which rational decisions are forged. When the market price drifts below this sacred mark, the stock whispers its undervalued allure. Conversely, when the market price soars beyond its grasp, it signals overvaluation, a clarion call to tread with caution. In the arsenal of valuation techniques, the discounted cash flow (DCF) method stands tall, like a mighty sword. It wields the power to estimate a stock's worth by projecting future cash flows, meticulously discounting them to their present value, and culminating in a sum that reveals the intrinsic treasure. In the grand tapestry of investing, understanding intrinsic value is a symphony of analysis and wisdom. It separates the astute investors from the reckless gamblers, illuminating the path to prosperity. So, embark on this odyssey, armed with the knowledge that intrinsic value is the lodestar in your quest for financial enlightenment. 2. The importance of intrinsic value. In the exhilarating arena of stock investing, understanding intrinsic value is akin to wielding a magic compass. This compass holds the power to lead investors through the turbulent waters of financial markets, revealing hidden treasures or warning of treacherous reefs. Picture this. The intrinsic value is your trusted ally, your financial oracle. When the market price of a stock aligns humbly beneath its intrinsic worth, it unfurls a tantalizing opportunity. It's the siren song, beckoning you to seize the moment and acquire undervalued gems that lie in wait. But wait, there's more to this mystical concept. When the market price dares to dance beyond the boundaries set by intrinsic value, it's a cosmic alignment, a celestial semaphore. It's as though the universe itself is sending signals. In such moments, the savvy investor recognizes the warning, the call to arms. It's time to part ways with overvalued stocks, safeguarding your wealth from the whims of a capricious market. Intrinsic value is the quintessential navigation tool in this grand financial voyage. It is the lighthouse in the storm, the compass that points north when the fog of speculation descends. It empowers investors to make decisions rooted in reason, not emotion. So, embrace the magic of intrinsic value, for it is the key to unlocking the doors of prosperity. It's the whisper in the wind, the ripple in the water, guiding you toward opportunity and protecting you from peril. In the realm of finance, it's not just knowledge, it's a superpower. 3. Fundamental analysis. In the dynamic world of stock investing, fundamental analysis is the ancient art of turning financial data into gold. It's akin to peering into the soul of a company, deciphering its past, present, and future. It's where numbers become narratives, and balance sheets transform into blueprints for financial success. Picture this. investors don the robes of financial wizards, delving deep into the arcane scrolls known as financial statements. These scrolls reveal the company's financial health, its very lifeblood. With the precision of an alchemist transmuting base metals into gold, fundamental analysts scrutinize earnings reports, tracing the company's profitability over time. They extract the essence of cash flows, understanding the company's ability to generate liquid assets, akin to elixirs of financial health. In this mystical journey, growth projections are the crystal ball, providing glimpses of the company's destiny. Will it soar to new heights or wither in the shadows? Fundamental analysts decipher these omens with the astuteness of seers. Amidst the alchemical cauldron of fundamental analysis, several enchanting metrics emerge. The price-to-earnings (P/E) ratio, akin to the philosopher's stone, helps discern if a stock is a hidden gem or fool's gold. The price-to-book (P/B) ratio is the map to the treasure, revealing the relationship between a stock's market price and its book value. And the free cash flow (FCF) analysis, the elixir of sustainability, unveils the company's financial resilience. 4. Discounted cash flow (DCF) method. In the labyrinth of stock valuation, the discounted cash flow (DCF) method emerges as a beacon, illuminating the path to true intrinsic value. It is the sorcerer's wand, weaving the intricate tapestry of a stock's worth by peering into the very heart of its financial destiny. Imagine this. You are a financial soothsayer, gazing into a crystal ball that reveals the company's future cash flows. These ethereal streams of revenue, like rivers of gold, hold the key to unlocking the stock's hidden treasure. With the precision of a skilled alchemist, you project these cash flows into the future, mapping out their ebbs and flows. But here's where the magic truly unfolds. You recognize that the future cash flows are not worth the same today as they will be in the future. Time, like an almighty sorcerer, wields its power. The DCF method, with its enchanted discounting process, bestows present-day value upon these future riches. It acknowledges the time value of money, ensuring that $1 today is worth more than $1 tomorrow. To cast this spell correctly, you must summon the most elusive and powerful ingredient, the discount rate. It's the magician's incantation, determining the rate at which future cash flows are brought back to the present. A high discount rate diminishes the future's allure, while a lower one bestows it with greater significance. The accuracy of this rate is pivotal in the art of DCF, as a slight deviation can lead to vastly different results. 5. Price-to-earnings (P/E) ratio. Amidst the sorcery of stock valuation, the price-to-earnings (P/E) ratio emerges as a mystic-looking glass. It allows investors to peer into the relative worth of a stock, providing insights into whether it's a hidden gem or an overpriced illusion. Imagine this. The P/E ratio is your enchanted mirror, reflecting the relationship between a stock's market price and its earnings. It's a gauge of how much investors are willing to pay for each dollar of a company's earnings. A low P/E ratio suggests that the stock may be undervalued, a potential diamond in the rough. Conversely, a high P/E ratio raises a cautionary flag, signaling potential overvaluation. But here's where the magic unfolds even further. To truly decipher the P/E ratio's secrets, you must not view it in isolation. It's a lens through which you compare a company's valuation with industry peers or historical averages. This comparative alchemy provides context, helping you determine whether the stock's P/E ratio is an anomaly or a common thread within its sector. In the grand tapestry of stock evaluation, the P/E ratio serves as both compass and telescope, guiding investors through the vast cosmos of equities. It's a valuable tool in the investor's arsenal, shedding light on the stock's relative value within the ever-changing constellations of the financial universe. 6. Dividend Discount Model, DDM. In the mystical realm of stock valuation, where numbers are the runes that foretell a company's fate, the Dividend Discount Model, DDM, stands as a venerable oracle. It is the ancient tome that unveils the intrinsic value of dividend-paying stocks, a favored tool in the arsenal of income-focused investors. Imagine this. You are a financial soothsayer, peering into the crystal ball of dividends. These are the treasures that flow from the heart of a company to its faithful shareholders. As a guardian of wealth, you understand the significance of these riches. But they are not mere coins. They are a stream of future cash flows, the lifeblood of income investors. Now, with the DDM in hand, you embark on a journey into the future. You project these precious dividends, like beams of moonlight, into the nights ahead. But you understand that the future is a shifting tapestry, and not all treasures shine equally. To bring these future dividends into the present, you invoke the power of discounting, just as an alchemist transmutes base metals into gold. The discount rate is your incantation, your wand of financial sorcery. It holds the secret to how much these future dividends are worth today. It is the key to recognizing the time value of money, where $1 in your hand today is worth more than the promise of $1 in the future. The accuracy of this rate is pivotal, as it shapes the intrinsic value that you seek. 7. Margin of safety. In the labyrinthine world of stock investing, where fortunes can be made or lost with a twist of fate, the margin of safety stands as the guardian of wealth. It is the shield that investors wield to protect against unforeseen perils and errors in judgment. Picture this. You are a wise guardian, tasked with safeguarding your wealth in the treacherous seas of the stock market. You understand that even the most potent spells of valuation carry an element of uncertainty. Projections can falter, market winds can shift, and unforeseen events can cast a shadow on even the most carefully crafted strategies. The margin of safety is your fortress, your bulwark against these uncertainties. It is the buffer that you incorporate when calculating intrinsic value. This buffer, like the sturdy walls of a castle, provides a margin for error, a cushion against unforeseen storms. Calculating the intrinsic value of a stock is a complex yet rewarding endeavor for investors. It empowers them to make rational decisions in the tumultuous stock market landscape. Armed with a deep understanding of a company's fundamentals and valuation methods like DCF, P/E ratios, and DDM, investors can navigate the market with confidence. Remember that intrinsic value serves as a beacon in the world of investing, guiding you toward opportunities and protecting you from pitfalls. So, embrace the art of calculating intrinsic value and embark on your journey as a well-informed investor.